Hi, folks, and thanks for joining us for another great video here at Street Smart Options. I'm Jim Bunker, and with me today is Jonathan Sherman. So, folks, if you're not in our free group on Facebook, you're going to miss out on some of the information that we share. We share a lot of it, and it goes onto our YouTube page. So if you're on our YouTube page right now and you're looking at our channel and you're watching this video, give some serious thought to that like button and subscribing so you don't miss great updates and videos like this. And our Facebook group is 100% free. So you should really think about going over there and joining that as well. All you have to do is find us on Facebook, and that's relatively easy as well. You just have to punch in the 3 letters SSO for Street Smart Options, and our group will come up. You can join it there on Facebook. So today we're going to be talking about option trading volatility. And Jonathan, if you want to take it from there.
Yeah, so options trading volatility is a topic that a lot of people are interested in, so I thought we'd cover it in this little video here. Options, the price of an option is determined by several factors, the main one being the price of the underlying stock. And the next major factor is the length of time until options expire, until the option expires, the time value. And then next is how much the price fluctuates, the volatility value. And implied volatility is a measure of how much demand there is for a particular stock option. And so if like before an earnings event, for example, implied volatility can be really high because people expect a big move in the underlying stock. And then after the earnings event, that implied volatility collapses back to the norm. And so the thing to look at with implied volatility is, relative implied volatility. Different stocks are going to have different amounts of implied volatility. Like, for example, a high tech stock was going to have a lot more implied volatility than like a utility stock, for example. And so the ways to trade implied volatility, you can trade it in two different ways. First of all, you can say, okay, this stock is near, on a chart, for example, it might be near a breakout point, and then implied volatility, if there's a lot of demand for the options at near that breakout on that chart without any other news events pending, that could be bullish, really bullish for the underlying stock, right? Because that means that there are maybe institutions that are buying those option contracts ahead of the price move in the stock because they're worried they won't be able to get enough shares. They're trying to accumulate shares, and so they buy those options ahead of the underlying move in the stock. And so that could be really bullish. So in that case, you'd be buying an option with a higher implied volatility, even though you expect that implied volatility to go down over time with the decay in time value. On the other hand, the other way of trading time, the other way of looking at implied volatility is if something's out of whack and there's a high implied volatility in a stock for no reason, and you can't really see that there's some big news event pending. Maybe the option is maybe a little mispriced, and you could try to benefit by selling that implied volatility. You might want to do like a credit spread to capture some of the premium in that stock option. Of course, the other thing to keep in mind is that a high implied volatility may mean that there's some news event you don't know about, so it could be a warning sign to stay away from that stock. And so there might be a higher risk actually on putting on a credit spread because that the underlying may blow out one way or the other because of some news event you don't know about, but some insider or some institution does know about. So I have in front of me here the chart of the VIX. And the VIX is the implied volatility of the near dated S&P 500 stock options. It's like an average of the implied volatility of the contracts on the S&P 500. And so it's a measure of the implied volatility, the average implied volatility across the whole market of the S&P 500 stocks. And so you can see that during periods of extreme fear in the market, like we had a big sell-off in January of 2018, the implied volatility spikes. And then after the sell-off and the market starts recovering, and during the bullish phases of the market, the implied volatility declines, right? And so it's very hard to time the market using implied volatility, because you can see, implied volatility can be low for an extended period of time before, before the market goes down, when in this case, the implied volatility goes way up. So as a timing mechanism, it's not really good. You can just get a sense, though, of what the overall implied volatility is in the marketplace. And, if there's a lot of fear in the market, it's probably a good time to start selling some premium, start capturing some of that implied volatility in some stocks in the market. Now, how in the real world, on day to day, maybe, how could you benefit from using implied volatility in your options trading? Well, I wanted to bring up a stock called Zendesk, and I've used this before in examples in some of our videos. And Zendesk is one of those companies that has a kind of a sticky business, so that you wouldn't expect a lot of volatility in the actual stock price, because it's a recurring revenue model in the business, and so quarterly earnings, institutional investors don't expect a lot of surprise in the quarterly earnings. And indeed, the Zendesk has proven that too, that there hasn't been a whole lot of surprises in the quarterly earnings. Now, mind you, the stock, even though alone when the market's increasing, is pretty non-volatile. When the market decreases, it'll fall like most stocks, right? But it's a good example, because you can use, in this case, you can use implied volatility to trade, to capture implied volatility when implied volatility gets out of whack. So I wanted to look at a chart of the implied volatility in Zendesk, and you can see that it rises into earnings and then collapses after earnings, right? Rises into earnings, collapses after earnings. And so you would expect that, when this thing collapses after earnings, you could be, buying the actual stock perhaps, right? You could be trying to benefit from the expectation that this implied volatility is going to be increasing. I should say buying the underlying option, right? Because and if you look at this, you can see that it increases into earnings starting maybe a month before earnings. So you could potentially buy the call option in Zendesk a month before earnings and then sell it before earnings, and you could capture some of that implied volatility. And then you could do actually maybe a debit spread to take advantage of this. And so you would be buying maybe an at the money call option, and then you would be maybe selling an out of the money call option and maybe trying to capture some of this premium. And so that's one way of trading these the implied volatility in these stocks. Now, there's there's a Greek called the Vega. Vega is an option sensitivity to implied volatility. What measures the price change, the contract's price changes in reaction to 1% change in the implied volatility of the underlying stock. And so you can watch Vega to see how sensitive the underlying stock is to changes in implied volatility. And obviously, a stock that is that has a higher Vega is going to move a lot more with respect to changes in this. So you can look at these implied volatility charts and look at Vega and say, hey, this stock is really going to move with a change in with implied volatility because the Vega is really high. And so, for example, with Zendesk, this a month before earnings would be a really good time to get in. So that's really all I wanted to say about implied volatility.
Awesome, Jonathan. Thanks for that. And folks, as I said before, you can get a bunch of free things from us, but what you can't get for free is the coaching and the training that goes on every day at Street Smart Options. So if you go to our website, streetsmartoptions.com, you can check out our product line and understand we have the ability to refer you right back to an expert who has over 30 years worth of trading experience, wrote for Forbes, and traded on the stock market. And that's Jonathan Sherman, my partner. So if you haven't done it, feel free to go to our website and take a look. And if you have any questions, contact me. That's Jim Bunker. By easily just finding me on Facebook or sending us a message in the group. That's the Facebook group that's free on Facebook. Thanks for watching our video today and have a great day.